Gold prices held up relatively well given the rate environment. Equities haven't done much. Adrian, I'll start with you. What do you think about that? Would you consider that to be a decoupling, the equities from the gold price? And as you mentioned during your first statement, you think we're on the cusp of a gold bull market. So I'd love you to elaborate on that.
Yeah. So that's been the big question everybody's been asking for the last 6 months. Why is gold doing well and gold stocks not? What's the decoupling? And to me, it's really, I hate to say this, but it's really quite straightforward when you think about it. And just think who has been buying gold over the last 18 months and why have they been buying? It's been central banks, we all know that, but it's been central banks who have been buying gold along with very wealthy families in the Middle East and Asia. It's not been retail buyers in North America. It's not been institutions in Europe and North America, by and large. They're not buying gold assets. So you only have to look at the premiums on gold coins, which are way down. You only have to look at flows into and out of ETFs. And for the last 18 months, it's been almost steady every month, outflows. Even in the last month, we're seeing outflows from ETFs. So the gold price is up because of central bank and, again, very wealthy Middle East and Asian families. So then the next question is, why are those people buying? They're buying as a hedge for security, as a defensive measure. So if you're buying for insurance, you buy physical gold. You don't buy consolidated Ajax, or whatever the name of the company is. And so it's really, when you think about it, it's really not a surprise. The gold has done well, and at the same time, the gold stocks have done badly. It's really not a surprise.
Okay, thank you, Adrian. Willem, what are your thoughts?
I fully agree, but there's a little bit more to that story. Because if you ask the question, why are they buying? Of course, they're hedging themselves. But this reminds me of the late 1960s. If you look at total demand from central banks, we just reached a new record, and we need to go back to 1969 to see that amount of physical gold buying by central banks. And what happened in 1969? Because that's very remarkable. In 1968, we had an implosion of the London gold pool. The London gold pool was cooperation by Western central banks to keep gold fixed at $35 per ounce because we were in the Bretton Woods system. And then France decided in 68 not to join forces any longer. So they stepped out and we had an implosion of the London gold pool. And that's why Nixon had to close the gold window a few years later. So central banks, they understood what was happening well ahead of investors, so they started to buy the physical gold because they understood that gold would go much higher. And eventually gold reached $800 10 years later. So why are central banks buying so much gold now? Because they understand there is a real confrontation between the West and the rest of the world now. The BRICS alliance, Brazil, Russia, India, China, most of these countries are buying huge amounts of physical gold. So they're working actively to build a parallel trading system, a parallel financial system. And this is very significant, and this point is missed by most investors. So I think we'll enter a whole new phase in the gold market where the traditional reasons why we should buy gold don't apply any longer, and it's just a geopolitical tool.
Quick break here, guys. Today's episode is brought to you by Copernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Copernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galiano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and Barrick on his board at Copernico Metals. Check out copernicometals.com. Now back to the interview.
I want to pull on that thread just for a minute because the central bank gold buying gets a lot of attention right now, as it should. It's significant. Ronnie Stoffele was just up here running some numbers past us, around 1,100 tons per year, rolling 12-month average last 18 months. But gold reserves for central banks have also been at an all-time low recently. And so is this, and correct me if you think I'm wrong there, because I may have that incorrect, but could this be looked at as a reversion to the mean, separately from...
No, it's more than that. If you look at who is buying gold, you know, you have Russia and China. They've been adding gold, especially since 2012, 2013, actually since the Maidan revolution in Ukraine. So that's where the new conflict started. But if you look, even in Europe, you have the Hungarian central bank growing their gold holdings 10x. You have the Czech central bank growing their gold holdings 10x. And that tells you something. And it's not only the geopolitical buying for geopolitical reasons, it's also the ongoing debasement of currencies. Most central bankers do understand that we're about to see this monetary reset somewhere in the next few years. And I've been writing and studying this for quite some time, and the signs are on the wall, just like the late 1960s. But you need to be an insider to understand the signals.
Okay, thank you, Willem. I appreciate that. Rick, thoughts on the gold sector? You talked about a number of other metals in your intro, platinum, palladium. We'll get to those in a minute. But what are your thoughts on the gold sector and gold equities right now?
Well, personally, with regards to gold, I'm just more comfortable buying it than not. Separate and apart from the central banks, I mean, a rational financial advisor would look at me, largest shareholder of Sprott, reasonable leverage to gold there, and say, why on earth would you own gold? Well, the answer to that is to sleep nights. The fact that I feel better about owning gold than not tells me as much as I'm ever going to know personally about the gold market itself. With regards to the equities, I think you need to look at three things in terms of the divergence between the gold price and the gold equities price. The first is the performance of the majors in the period 2000 to 2011. The gold price increased sevenfold, and the free cash flow per share on the XAU fell. That took special skill to screw up a sevenfold increase in price. So the investor looks at the gold industry and looks at an unrivaled track record of destroying capital. And it takes time to get past that. I'm going to make the audience sick before I make them well. In the juniors, if you merged every junior exploration company in the world into one company, Junior Explorco, that company would lose $2 billion in a good year and $6 billion in a bad year. So what should you pay for losing $2 billion a year? Would you pay 7 times losses, 11 times losses? That, though, denies the fact that 10% of the issuers out there generate so much performance that they add credibility and occasionally even luster to a sector that loses $2 billion a year. And we're in a market now where the sentiment is so bad that the investor doesn't differentiate between the good and the bad and the ugly. One final thought, and I appreciate the European perspective. The American perspective is that precious metals related assets comprise less than 0.5% of the total value of all savings and investment assets in the United States. The 40-year mean is 2%. I expect a reversion to mean at least, and a reversion to mean quadruples demand for precious metals related assets in a market that constitutes 20%, 22% of the world's savings and investment assets. In fact, it might correct past a reversion to mean, but I don't need that to make my case. If the market share of precious metals just in the US market reverts to mean, which is what I think is going to happen, demand for the stuff quadruples.
Okay.
You tell me where the price goes with prices set on the margin if demand quadruples.